Today I am analyzing companies like Thirumalai, Nocil, Philips Carbon, Balaji Amines and Pidilite, which are into chemical sector. Let us analyze these companies using graphs. The current market price of Thirumalai is 63 rupees, Nocil is 85 and so on. Pidilite is the most expensive of these companies at 1273 rupees per share. The stock price itself is not expensive. We need to look at other companies' prices along with its face value. Thirumalai has fallen 65% from its 52 weeks high or from 1 year back. And Nocil, Philips, Carbon and Balaji Amines have also seen a corresponding fall of more than 50% each during this last 52 weeks. Pidilite is the only stock which has fallen the least from where it was 1 year back at 3%. Next, let us look at the earnings yield percentage. That is, on the current price, what was the profit that the company has earned? Thirumalai's earning yield was 11.1%. So here we're looking for the highest yield percentage, which suggests that whatever price we have paid against that, the company is earning a good profit. Thirumalai's price was 63 rupees and the company's earnings per share or EPS was 7 rupees in 2019. That translates to an yield of 11.1%. The highest earnings yield was seen for Balaji Amines at 16% on a price of 225 rupees. The company's earnings per share was 36.1 rupees. The lowest earnings yield was seen for Pidilite, the price being 1273 and the earnings per share was 18.2 rupees, translating into an yield of 1.4%. So here we want an earning yield which is the highest. Next, we'll look at the price to earnings ratio. This is calculated exactly opposite to how we calculate the earnings yield. In earnings yield, we divide the earnings per share by price, whereas in price to earnings, we divide the price by earnings per share. Thus, we can understand where the price is quoting compared to its earnings per share, or how far away the price is compared to its earnings. Thirumalai price was 63 and earnings per share was 7 rupees. That is, the investors were willing to pay 6.9 times higher than the earnings. The highest earnings yield was seen for Pidilite, where the difference between the price and the earnings per share was 68.9 times. Whereas the most reasonable of the lot was Philips Carbon, whose price was 121 rupees per share and earnings were 22.3 rupees, thus translating to a price to earnings ratio of 5.5 times. Here we would want to invest in a company whose price to earnings ratio is below 25 times. That is, the investors should not pay more than 25 times the earnings per share of the company. The higher we pay, the more expensive it becomes. Next, we will compare the current price earning that we paid in 2019 or as of date with its 5 years historical price earning and last 3 years historical price earning. Thirumalai's investors were willing to pay 6.9 times in the current year, but last 5 years the price was trading 8.8 times higher than the earnings, and in the recent 3 years it was quoting at 9 times. So as of today we are getting the company's shares at a reasonable multiple to its 5 and 3 years average. As usual, the highest earnings yield was seen for Pidilite. In the recent year, the price was quoting 68.8.9 times higher than its earnings, and it has even become more expensive than its 5 and 3 years average price earning multiples. It seems that Balaji is the most reasonable when compared with its 5 and 3 years multiple. 6.4 times is the current price earning multiple against the 10.6 of the last 5 years and 12.9 of the last 3 years. Even Philips Carbon has become very attractive at this 5.5 times multiple against its 5 years and 3 years multiple. This price earning multiple that we are analyzing is only to understand where the price is compared to its earnings and compared to its historical averages, so that we don't pay a very high multiple against the earnings. We will also have to compare the price to earnings ratio with the price earnings growth ratio, so that whatever multiple we are paying for the earnings of the company, we should also get a similar kind of growth rate in that earnings. Investors who pay high multiple against the earnings should definitely look for high growth and high profitable companies. Next, we'll comparing current market price with the operating cash flow that the company has generated for each share. Operating cash flow is the cash inflows and outflows out of the business operations of the company. Unlike earnings, where we are considering all inflows and outflows of whether it is by way of cash or non-cash. Everything is accounted for in the earnings, whereas in the OCF, only cash inflows and outflows occurring out of the normal business operations are considered. This is a more true picture of how much the business has earned from the operating activity of the business. Thirumalai's price to OCF is 2.8 times, which means that the price is quoting 2.8 times higher than the operating cash flow per share. As usual, the highest multiple of price to OCF was seen for Pidilite at 76 times. Here again, we don't want to pay more than 25 times of the operating cash flow. The other three companies, Nocil, Philips and Balaji, all three are also trading at a reasonable 8.6 and above, slightly above 7.2 times. Next, we will compare the price with its free cash flow. The free cash flow is calculated by removing expenses incurred in buying of fixed assets from the operating cash flow. After we deduct the expenses, whatever remains is the free cash that the company can use in financing activity, which would include buyback, bonus, or repayment of loans, etc. for acquisition. Here also we don't want to pay more than 25 times of the free cash flow. Thirumalai's price to free cash flow was 15.9 times, again suggesting that the price was quoting 15.9 times higher than its free cash flow. Here we want to pay as low as possible. Nocil had a negative free cash flow to price ratio, which is suggesting that the free cash of the company was in negative, meaning in the latest year companies didn't have any free cash flow left. In fact, it has spent more than what it has earned in the operating activity. Same is the case for Balaji Amines, where it has spent more than its operating cash into buying of fixed assets. Philips Carbon also had a high multiple between the price and the free cash flow, suggesting that companies' cash flow were quite low, or free cash flow were quite low compared to the operating cash flow. Pidilite ratio was in positive but had a very low free cash flow compared to the OCF. The lowest multiple suggests that the company's free cash flow were quite high compared with the operating cash flow. That is, most of the operating cash flow is still there with the company as free cash. Next valuation metric that we are looking at is price to book value, or we can also say the entire market cap compared with its net worth. That is, what is the value of each share as in the company's records? What is the value of the share as per the company's books? The book value is calculated by removing or by paying off all liabilities by selling all assets, and whatever is left over is the net worth of the company or the book value of the company per share. In terms of price to book value, we don't want to pay more than 2.5 times. All of these companies were trading at a reasonable price to book value multiples of less than 1.5 times, except Pidilite, whose price was quoting 15.6 times higher than its book value. This suggests a very high premium that the market participants are giving to this company. Now, as we look at all other ratios, we'll understand whether this multiple is justified. I generally wouldn't touch any companies which are trading at a high price to book value multiple above 2.5 times. Next, I'm looking at price to sales ratio, where we are trying to understand the multiple that we are paying against the sales. Thirumalai Chemicals' entire market cap or price per share was trading at 50% discount to its sales of 2019, meaning the entire market cap was quoting 50% lower than the sales it managed to do in 2019. Here, we don't want to pay a very high multiple against the sales of the company. Pidilite's price was quoting 9 times higher than its sales per share, or the entire market cap was quoting 9.1 times higher than the complete or revenue that the company generated through sales. Nocil's price was quoting 1.4 times higher than the sales. Both of these multiples are of a very great value to investors to judge where the current market price is. As I mentioned, for price to sales, we don't want to pay a very high multiple against what the company is generating as revenue through sales. Next, let us check the profit growth rate of the 5 years and profit growth rate in the last 3 years. Thirumalai Chemicals profits have been growing at 54% since last 5 years and 52% since last 3 years. That is a very high growth rate. We need to look at the base year and try to understand how the profit has been growing. Nocil also had a high growth rate of 49 and 32% year on year for both 5 and 3 years. These are CAGR growth rates, that is compounded average growth rates. Philips Carbon saw a huge growth rate of 196%. Whenever we look at this kind of growth rate, we need to look at the base year profit figure and then try to understand whether the profit that has been showing here in terms of percentage, is that because of the low base year, or is it because there is a growth in the profit? Balaji also saw a 27 and 25% growth rate in profit from 5 and 3 years back. Pidilite profit was at a reasonable 16% growth rate since last 5 years and a 5.3% growth rate in the recent 3 years. So Pidilite has grown at the slowest pace. When we are analyzing the profit growth rates, we have to look for at least a 10% growth rate over a period of 5 and 3 years. Next, let us look at the PEG of the 5 years, that is the price earnings to profit growth rate of the last 5 years. This ratio helps us understand whatever price we have paid for the earnings, is that earnings growing at a high percentage. If it is, then it means that we'll be able to recover our invested capital much faster. Thirumalai's price earning paid by investors was 6.9 times, against which we are getting a growth rate of 54% since last 5 years. So that translates to a PEG of 0.2. What we do is we divide 6.9 by 54, and we then understand that although we have paid 6 times more than the earnings, that earnings is growing at the rate of 54% every year since last 5 years. So we are looking for a PEG of below 1.5 times. That would automatically suggest that we are paying a very reasonable price against the earnings. Nocil also had a 0.2 PEG. We are paying 7.7 times the earnings, and the earnings is growing at 49%. Philips Carbon's profit growth rate of the recent 5 years is not there because the profits because the company had a loss 5 years back. Therefore, the growth rate cannot be calculated when the base year's profit value is negative. Balaji Amines also saw a 0.2 PEG, basically translating into a 27% growth rate for a price earning of 6.4 times. Pidilite saw a high PEG of 4.3, so paying a price earning multiple of 68 times is not justified because we are not getting a growth rate according to that. Next, we'll understand the PEG of the recent 3 years. All of these companies' PEG is below 0. Or is around 0.2, which again suggests that the price earning multiples are very attractive because we are also getting a corresponding growth rate in profits. Only Pidilite's PEG was high at 13 because the price earning multiple was high in the recent year. That is, we are paying 68 times more than the earnings, but the earnings are not growing at a high percentage, because of which the PEG has increased to 13. So we are looking for a PEG of 1.5 and below. Next, let us look at the growth rate in sales for both 5 and 3 years and see how the company has managed to grow its sales. Thirumalai's sales over a period of 5 years has shown a fall of 0.2%, which is not a good sign. It's a very minor fall, but still we would want to see a growth rate of at least 10% from 5 years back. From 3 years back, the sales has grown at the rate of 10.3%, which is a positive sign. Nocil has seen a growth rate from both 5 and 3 years back of 11 and 13%. Philips Carbon saw a growth rate of 9.2% in sales from 5 years back and 23% growth rate from 3 years back. So what we are trying to understand here is that the 3 years growth rate has to be much faster than the last 5 years. That shows that the company has managed to grow its sales much faster in the recent 3 years than what it has done since last 5 years. And also we want to have a figure of 10% growth rate or above. Balaji Amines sales also saw a growth rate increase from 9.1% to 13.7% in the recent 3 years. Pidilite has seen a reasonable 10% growth rate in the last 5 years and a 9.7% growth rate in sales over the last 3 years. This is an important metric or an important ratio to look at because it shows us how the management of the company has done, or what it has done to keep increasing the sales. It shows in an efficiency in a kind of a way, because sales is a very important part of the company's performance. If the demand for the company's product is not there, the sales will drop, and also the revenue generated on the sales will go down, and we'll also see a corresponding fall in the profit because of that. Next, let us look at the profit these companies have generated on the shareholders' money. That is the ROE of the 5 years average and the recent ROE of 2019. This is the return on equity. Thirumalai's ROE was 20% for last 5 years average and 18% in the recent year. So the return on equity has fallen below its 5 years average, but it's still okay because it's above 15%, which is my benchmark. So this is a good value. Nocil has seen a very stable 5 years, and even 2019 ROE value was 16.6%, very near to its 5 years average. Philips Carbon saw a growth rate of 25% in the recent year of 2019 against its 5 years average of 13.6%. So the company has performed better from its average. Balaji Amines also saw a double digit, about 20% growth rate in ROE, rather percent margin of 23% and 22% over both 5 years average and the recent year. Pidilite's ROE for both 5 and 3 years was 27% and 24%. So these companies have a very good margin on the shareholders' money of about 20% for most of them. My personal benchmark is above 15%, which I am looking for in return on equity. Next, let us look at return on capital employed. Here, capital employed is composed of fixed assets plus the working capital, and we take the average of the two and we divide the EBIT by it. This is the earnings before interest and tax. Thirumalai's RoCE for both 5 and 3 years was about 25%, and most of these companies have generated a good RoCE value of about 25%. We would also want that the recent RoCE value be above the 5 years average, like in Nocil, where its 5 years average was 23.6%, and the recent return on capital employed was 24%, higher than its 5 years average. Although these values are still good because they are above 15%. Here, what we are trying to understand is how the company has managed to gain or earn profits on whatever fixed assets it employed into the business, along with the working capital. The other formula for return on capital employed is net worth plus borrowings. Many people consider that also as capital employed, but in this case I have considered fixed assets plus the working capital and taken the average of the 2 years. Next, let us look at the return on assets over the last 5 years on average. The assets in this case is the total balance sheet size less the current liabilities. So this is the total capital employed in this case. We are considering all assets and just removing out the current liabilities. And for the profit value or the return value, we are considering the net profit. Thirumalai Chemicals has earned 14%. Nocil has earned a 14% return on assets on the total assets employed by the business. The least return was generated by Philips Carbon at 6.6%, and the highest return was generated by Pidilite at 25.4%. This shows the efficiency with which the assets are being converted into profit. So the higher the value, the better it is. Next, we'll look at the asset turnover. In this case, we are trying to ascertain how well the company has converted its net worth plus borrowings of the recent year into the sales. Thirumalai Chemicals sales was 1.6 times higher than the assets employed into the business. Nocil managed to come very near to the amount of assets employed and convert that into sales. And the other three companies have managed 1.4, 1.2 and 1.7 times sales of the assets employed. So here too we want it to be more than 1 times and as high as possible. So that shows the efficiency of the management to convert its capital into sales. Whatever money the management has employed into the business, that is being converted into sales. Next, let us look at how the profit of the last 5 years, how much of that profit has actually come into the business in terms of cash from operations. Thirumalai's profit over the last 5 years was 373 CR. Of that, it has received 88% more than that as cash of 702 CR. What we are trying to ascertain here is whether the profit that the companies have shown is that getting converted into real cash or is that just a paper profit. Thirumalai Chemicals profit after tax was 373, against which the cash coming in through operations was 702 CR, which is an 88% more than the profit. Here what we are trying to understand is that if the company has shown a profit of 373 CR, is that profit actually getting converted into cash, or is that a profit which also includes many non-cash related expenses and incomes? So for example, if the company has shown a profit of 373 CR, that would also include the sales that the company has done on credit. Now, if the company is not receiving that money from the debtors or from the accounts receivables or from the customers who have purchased on credit, then that profit is of no value because the company still has to collect that payment. Now, what the cash from operations suggest that only, in fact, this cash from operation includes only the incomes and expenses which have been already done in cash. So if the debtors have not paid or the customers have not paid out of this 373 CR, it would get reflected in the cash from operations. Also, when the company reduces the profit by showing depreciation expenses, then that depreciation is basically a non-cash expenditure. That is, nothing is going out of the company for the depreciation that is deducted from the P&L account. So in the cash from operations, we add back that depreciation expenses. So that shows that the actual profit of the company in terms of cash was 702 CR and not 373 CR. Nocil's profit for 5 years was 589 CR, against which it received a cash of 609 CR. So this is a good value. So it's basically 3% higher than the profit. Phillips Carbon saw a 98% increase in its cash against the profit of the 5 years. Balaji Amines saw a growth rate of 9% in cash against the profit. Pidilite saw a fall of 4% in cash received against the profit of the last 5 years. So as I mentioned earlier, we want the cash coming in through operations to be more than the profit after tax value, and as high as possible is better. When we see a negative value, that's a kind of sign of worry. Although for Pidilite it's just a 4% decrease in cash, that is a shortfall of 4% in cash against the profit. This is a minor shortfall that can always be recovered. But when the shortfall increases to a high percentage of, say, 30% cash not coming in against the profits, then that starts to worry me, because if the company is showing a profit of, let's say, 4600 cr and 4000 cr, and 2000 of that has not come in terms of cash, so then that should be a sign for worry for anyone. Next, we will compare whatever cash has come in from operations over the period of last 5 years. Of that, how much is still left over as free cash flow with the company? So the value for the free cash flow is calculated by removing out expenses, that is cash expenses done on buying of assets. So we remove the expenses incurred on buying of fixed assets or assets from the cash flow from operations. So when we do that, what we get is the free cash flow left for distribution in the financing activity. Investors should look at a cash flow statement to understand how the company's cash has flown out or in the company, and that will give them a very good picture of the company, on what the company has actually spent on buying of fixed asset, how much it has paid to purchase assets, how much it has received from debtors in cash, how much it has paid creditors, and so on. All of those details are there in the cash flow statement. Thirumalai's cash coming in was 702 cr that we saw earlier. Of that 702 cr, 378 is left out as free cash flow. That is, this amount can be used in the financing activity to pay dividends or give bonus or do buybacks or use for the acquisition purposes. And this 46% that is being shown here is the amount of value or percentage of the 702 cr being used in buying of assets or used in investing activity. So to recap, out of the 702 cr, 46% is used in buying of fixed assets and 378 cr is left out as free cash flow. Nocil's cash coming in was 609 cr. Out of that, 312 is left as free cash flow, and 49% of 609 cr was used up in buying of fixed assets or invested in assets. Philips Carbon saw a 31% investments in assets, and out of 1386 cr, 952 cr is still left as free cash flow. Balaji Amines saw a 76% investments in assets. Out of this 435, 76% is used in buying of assets and only 104 is left out as free cash. So we don't want, or at least I don't want, to see a value exceeding 50% being used in buying of fixed assets. I want a moderation in how the company is growing, how it is investing in assets, and how much it is keeping it for itself as free cash, so that it can use it for, say, paying off loans or paying dividend and so on, as I explained earlier. So only Balaji Amines has seen a majority of its cash earned through operations being utilized in buying of fixed assets, and it has only 104 cr left out as free cash flow. Pidilite Industries also saw only 31% investments in fixed assets out of all its cash of 3,894, and it has a huge amount of free cash flow left with it at 2,671 cr. Next, we'll look at the profit after tax of the latest year and compare it with how much of that profit of the latest year of 2019 has actually got converted into cash from operations. In the previous graph, we saw that over the 5 years how the profit is getting converted into cash. But in this graph, we'll look at how in the latest year the profit has got converted into cash. Thirumalai's profit in the latest year of 2019 was 114 CR, whereas the cash coming in was 234 CR, which is 106% gain from the profit. Nocil's cash coming in from operations was less than the profit after tax of the latest year. There's a shortfall of 10% in cash coming in. All the other three companies have also seen less cash coming in through operations than the profit. The highest shortfall was seen in Philips Carbon, where it received only 290 CR as cash against the 378 CR shown as profit, which is a shortfall of 23%. Even Balaji Amines saw a shortfall of 18% and Pidilite saw a shortfall of 10%. Only Thirumalai managed to gain more cash, or more cash came in against the profit after tax of 2019. Here too I would like to see a value which is higher than the profit after tax. That is, the cash coming in should be more than the profit after tax. Next, let us look at the profit after tax of the latest year and how it has managed to gain over its 5 years average. This will help us understand whether the current 12 months profit is above its average of 5 years or below the average. Thirumalai's current year, or that is 12 trailing months profit, was 94 CR against the last 5 years average of 75 CR, which is a 27% gain above its 5 years average, which is a good sign. Nocil and in fact all of these companies have managed to gain higher profits than its average of 5 years. The highest profit in terms of percentage over its 5 years was by Philips Carbon, where its 5 years average profit was 140 CR, and in 2019 it has earned 378 CR of profits, which is 171% gain from its 5 years average. So this way we can understand how the profit is, what is the trend in profit. Here, the higher the value, the better it is. Pidilite saw a gain of 15% above its 5 years average. So all these companies have managed to gain more profits than its 5 years average. Next, let us look at how the profit has grown year on year from 2018 to 2019. Thirumalai's profit has decreased from its previous year, that is from 2018 to 2019. The profit has seen a fall of more than 33%. From 170 CR, the profit in 2019 was only 114 CR, which is a shortfall of 33%. Nocil saw a 7% gain in its profit from its previous year. The highest gain was seen for Philips Carbon at 67%. In 2018, the profit was 226, and in the current year, the profit declared was 378. Pidilite saw a shortfall or a fall in its profit from its previous year by a mild 2% drop. That is from 958 CR earned in 2018. In 2019, the profit shown was 939 CR. That is a drop of 2%. Here we want the profit to increase year on year by at least 10% and above. Let us analyze the quarterly sales and profit growth rates for year on year analysis, that is from June 2018 till from June 2018 to June 2019. This is the 3 month analysis comparison over year on year. Thirumalai's sales has increased by 12% year on year, that is from June 2018 to June 2019. the sales has increased by 12%, but the profit has seen a huge fall of 61%, again from year on year. So here, when we are analyzing quarter on quarter results, we want to see a growth rate of a positive value and at least 10% and above. Most of these companies, as can be seen, have seen a fall in their profits in the latest quarter of June, which suggests that there's some kind of pressure on these companies from the year ago period. Either that, or in the year ago period they may have earned a very high profit, and in the current quarter of June the profit seems to have fallen quite a bit. Thirumalai saw the highest fall in its profit from June of the previous quarter. Nocil saw a fall in both its sales and profit. Sales saw a degrowth of 14% and profits saw a fall of 35%. Philips Carbon's sales increased by 17%, but the profit decreased by 34%. Balaji Amines' profits and sales both have seen a fall of sales saw a fall of 11% and profit saw a fall of 41%. So these are negative values for Balaji. Pidilite saw a growth in its sales, but there was no gain in profit. So it seems that most of these companies have seen some kind of pressure on their sales as well as their profits. Next, we'll look at the quarter on quarter analysis, that is from March 2019 to June 2019. This is the nearest analysis that we can do in terms of quarter on quarter analysis. Thirumalai and almost all companies have seen a further shortfall from March quarter. Thirumalai saw a fall in its sales by 8% and a fall of 32% from its previous quarter. So all of these numbers are negative. Nocil also saw a shortfall or a fall in its sales as well as profit. Philips Carbon saw a mild drop in its sales, but a large fall in its profit by 13%. Balaji Amines also saw a shortfall of 1% in its sales, but a 26% drop in its profit. Pidilite sales dropped by 11%, but the profit increased by 7%. So none of these companies have done well in the recent quarters. In fact, year on year also analysis have shown a negative result for this company. So there seems to be definitely some kind of pressure on these companies' margins. Next, let us look at the net worth and contingent liability. Here we are looking at what is the actual value of the company against not looking at the market cap, but at the actual value of the company. The net worth is calculated by selling all assets that the company has and paying off all liabilities. And whatever remains after that is the net worth, which is distributed to the shareholders of the company. Contingent liability is the liability which is a contingent on or based on certain situations that may arise in the future. Contingent liabilities are not shown in the balance sheet or not disclosed in the financial statements. Instead, it is shown as a note to the balance sheet, which then means that these liabilities are not there included in the balance sheet. So one has to be careful that the company is not carrying a very high contingent liability against its net worth. For my calculation, I don't want the contingent liability to exceed 20% of the net worth. First, let us compare the net worth. The highest net worth or the size in terms of size of the company was Pidilite at 4,000 CR. Philips Carbon is a 1,650 CR company. Nocil is a 1,163 company. These are all in crores. Thirumalai Chemicals is a 668 CR company in terms of net worth. None of these companies have a substantial contingent liability against the net worth of the company. Pidilite industry had the highest contingent liability of 8% against its net worth of 4,140 CR. So all of these companies have done well in terms of limiting their contingent liabilities. Next, let us compare the debt to equity, then debt to profit, and interest coverage. I'll quickly explain each term. Debt to equity compares what was the borrowed money against the money invested by the shareholders. We don't want a very high borrowed money in the company, because that would mean that we have to pay, or the company has to pay, a interest cost or a finance cost on this borrowed money. So we want to keep the debt to equity ratio below 1, which then would suggest that the company's interest cost, finance cost is low. Thirumalai Chemicals debt to equity was 0.2 times, which means that debt was just 20% of the equity contribution, which is a good value. Nocil had no debt, it's a debt-free company. Even Pidilite is a debt-free company. Philips Carbon and Balaji Amines each had a debt to equity ratio of 0.5. For Philips Carbon, the debt was half of the equity, and Balaji Amines debt was 40% of the equity contribution. So here we want the debt to equity to be as low as possible, below 1 times, and most of these companies have kept their debt to equity ratio below 1 times. Next, let us look at debt to profit. This ratio helps us understand how much is the borrowings against the profit of the company. So to understand this, let us look at Thirumalai. Thirumalai's debt to profit is 0.9 times, which would then signify that if the company wants to pay off its debt, then it will take less than 1 years of profit to clear off that borrowing, which is 0.9 times. That is, the borrowings is 90% of the profit of this year of 2019. So this is very good. We want the debt to profit to be as low as possible. Nocil, since had no debt, therefore there is no debt to profit ratio, because there is nothing to compare against the profit. Philips Carbon's borrowings were 2.1 times higher than the profit of the 2019. That is, if we consider this current year's profit, then it will take it 2.1 years to pay off that entire debt. So this is also good. We don't want a very high value, but in terms of other group companies, Philips Carbon's borrowings were the highest. Balaji Amines would take around 2 years to pay off its borrowings using the current year's profit. Pidilite's, since debt was zero, negligible, therefore there was no debt to profit ratio. Next, let us look at the interest coverage. Here we are trying to compare what was the finance cost and what was the EBIT, or earnings before interest and tax. So here we are trying to understand whether the operating profit that the company has earned, is that enough to pay off its finance cost, and how comfortably it can pay off that interest cost that it has taken, that it has done on its borrowings. Here we want the debt interest coverage to be more than 4 times. That is, the EBIT, or interest before EBIT, should be more than 4 times the interest paid in the latest year. All these values are of 2019. As we can see, all of these companies have a very good interest coverage of more than 4 times. That is, their EBIT is more than 4 times its interest payment. The highest was for Nocil, since it's a debt-free company. Its earnings before interest and tax was 438 times higher than the interest, if whatever it has paid. Next, we'll look at the promoter holding and pledged shares. Promoter holding signifies the shareholding of the promoters in the company, and pledged shares signifies what is the pledge of the promoters on their holdings. And if they have done pledge, we don't want the pledge shares as a percentage of promoter holding to exceed 20%. When the promoters start pledging their shares, that signifies that most of the shares of the promoters, against that the promoters have removed money or received money, and if they don't repay that part of the pledge to the financial institutions, most probably those banks or financial institutions will sell off those shares in the open market, and that would basically create a panic in the market and the prices will fall. If there is too much supply in the market at one time, the prices drop and more and more people start selling in the market. Thirumalai's promoters holding was 42%. In this particular promoter holding percentage, I would like it to be more than 30%. Anything below that is a low promoter holding, and if the promoters are not interested or have a low promoter holding, then that basically means that promoters itself have very less stake in the company. So we would want to invest in companies in which promoters have a high stake, and if promoters have a lot of interest in running the business well, that would directly benefit the shareholders. Some of the companies don't have any promoter holdings, so then in that case it's okay because there are no promoters in those companies. For example, Bombay Stock Exchange, ITC, and there are a few more companies. There's no pledge in Thirumalai of any of the promoter holding. Nocil had a pledge of 25%. The promoter holding is 34%, and out of this 34%, 25% has already been pledged. So for me, the pledge share for Nocil is high because I want it to be below 20%. It should not exceed more than 20% of the promoter holding. None of the other three companies have any pledge shares against their promoter holding, and the promoter holdings are also above 50%. So most of the promoters here are in majority. Next, let us look at the debtors to sales, debtor days, and debtor days 3 years back. The debtors to sales compares how much of the payment to be received from customers is still pending against the current year's sales. The debtor days looks at how fast the company is collecting payment from the customers, and debtor days 3 years back looks at how the company was collecting payment from customers from 3 years back. Debtors to sales should not exceed 20% of the sales, that is the money to be collected from customers should not exceed 30% of the sales. So in this case, none of the companies have exceeded 30% of the sales. Thirumalai's debtors to sales was just 8.7%. That is, whatever sales the company has done in the current year, against that, only 8.7% are standing as debtors or accounts receivables or customers from whom the company has to collect payment. The highest collection was to be done by Nocil at 22.3%. That is, against the sales of the current year, the payment to be collected from customers was almost 22% of the sales, which is a high value, although it's less than 30%. The other three companies have also a very similar double-digit collection of 18.5, 17.8 for Balaji, and 14.9% for Pidilite. Although these values are okay because they don't exceed 30%. Thirumalai is collecting payment from customers within 33 days in the recent year of 2019, and 3 years back it was taking 50 days. So it has basically improved the collection. Now it is collecting much faster from its customers. Nocil's collection days has increased. Not only are the debtors the highest, that is the amount still to be collected against this year's sales is the highest, but also the collection days are the highest. It's taking 81 days in 2019 to collect payment from the customers. 3 years back it was 77 days. So definitely it's performing much poor in terms of collection. Philip Carbon's collection was 18.5% from debtors, and that it is collecting within 68 days. 3 years back it was collecting in 84 days. So it has decreased now. So this is a good sign. Balaji Amines has also seen collection days decreasing from 71 to 65 days. Pidilite saw a slight increase in its collection period from 48 days 3 years back to 54 days. So for me, my benchmark is less than 90 days. That is, the companies should collect payment from the customers within 90 days, and the debtors to sales ratio should not exceed 30%. Next, let us look at how the company's inventory was turned over into sales, or how many times the inventory was turned over into sales in the current year, and then compare it with 3 years back's inventory turnover. Thirumalai Chemical inventory of the current year was converted 8 times more into sales. That is, sales was 8 times higher than its inventory holding. 3 years back, the conversion of inventory into sales was much higher at 9.3. So this is now decreased. We want it to grow above its 3 years inventory turnover. So that signifies that the company is now generating more sales against the inventory holding. Nocil has managed to gain slightly above its 3 years inventory turnover. This is the inventory turnover that it did 3 years back. Philips Carbon also saw a growth in its inventory by 9.2 times, whereas 3 years back it was doing 7.9 times. Balaji Amines was almost the same. Whatever turnover was there 3 years back, it's the same in the current year also. And Pidilite is also very nearby to 8.1 times its inventory was converted into sales. So there is no particular benchmark here. We have to compare it with other group companies and see how other group companies are doing. So the more the turnover, the more efficiency it shows. Next, let us look at the operating profit margin of the last 5 years on average, and also look at the latest net profit margin that the company has earned, and also compare that with the net profit margin of the preceding year, that is of 2018. Thirumalai Chemicals operating profit margin was 14.1%. Here my benchmark is at least 15% the company should be earning as operating profit margin, because after this particular profit, we also have to deduct interest cost, depreciation, tax, if there is any extraordinary item or exceptional gain or loss, that also has to be deducted from this operating profit. So after deducting all these expenses, we want our net profit margin to be at least 10% and above. Thirumalai's OPM, as I mentioned earlier, was 14.1%, which is a shortfall from our benchmark of 15%. Net profit margin of the latest year was 9%, again a shortfall from the benchmark of 10%. In 2018, it managed 13% of NPM, which is a good sign. But in the recent year, the profit is not up to the mark. Even OPM is not up to the mark. Nocil OPM was 23%, again very good. But the NPM also saw a good double digit 17.7% of net profit margin. In 2018 also, the net profit margin was very similar at around 17.6. So Nocil has done well in terms of generating NPMs and OPM. Philips Carbon operating profit margin was low of the last 5 years at 12.7%, but in the recent year it has still managed above benchmark of 10.9% gain in net profit margin. In 2018 it was low at 9%. Balaji Amines OPM of the last 5 years on average was 20%, which is a good thing. Even NPMs were quite high at 12.5% in the latest year and 13.2% in 2018. So Balaji Amines has also done well in terms of margins. Pidilite OPM was a good 20%, and even NPMs were good at 13.1% and 15.8%. So Pidilite, Balaji, even Philips Carbon for that matter, as well as Nocil, all these 4 companies have done well. Thirumalai has fallen short by a minor 1% drop in NPM and 1% drop in OPM as well. Next, let us look at the current ratio and quick ratio. Current ratio helps us understand the liquid position of the company. That is, how well can it clear off its current liabilities or the liabilities which it has to pay within 1 year. Against that, does it have the assets, current assets, to sell and pay off those liabilities. Quick ratio would then compare the same thing but using quick assets, that is those assets which can be quickly sold and converted to cash and pay those current liabilities which may arise in this year. So this shows the liquid position of the company. Does the company have enough current cash to pay off those liabilities? And if it does not have, then that creates a problem for the company. It may have to borrow from the banks or it may have to borrow at a higher rate of interest. Current ratio should be more than 1 times, that is, current assets should be more than 1 times of current liabilities. In other words, current assets have to be more than the current liabilities so that the company is in a good, comfortable, liquid position. Thirumalai's current ratio, in fact, all of these companies have a good current ratio, that is, its assets are enough to pay off its liabilities of the current year. But in terms of quick ratio, Thirumalai fell short by 1 times. Its quick assets are not enough to pay off the current liabilities. Nocil had a good quick ratio of 1.2 times, that is, its quick assets are also enough to pay off the current liabilities. Philips Carbon fell short by 0.1 times. Its quick assets were not enough to pay off the current liabilities. And Balaji and Pidilite had enough quick assets to pay the current liabilities. So all of these companies have done well except Philips Carbon and Thirumalai Chemicals in terms of liquidity position. Next, let us look at the accumulated depreciation on the gross block. Gross block is basically the total assets of the company at their acquisition cost. This is the assets that are still being depreciated and they will keep getting depreciated until the value becomes zero of all these assets, and after that they will be wiped out from the balance sheet. So up till now, Pidilite has the largest amount of assets of 2,537 crore, on which 43% of that asset has already been depreciated to P&L account. That is, the expenses to be deducted over the number of years of this 2537, 43% has already been removed out. The accumulated depreciation is 1089 crore and this has already been expensed. So we don't have to worry about this. The only thing this graph is showing is how much is the assets standing in the balance sheet at its acquisition cost, and of that how much has already been depreciated. So after the depreciation, we can understand that only 1089 crore of assets for Pidilite is still to be depreciated. So this expense it has to deduct from the P&L account in the future years. So we want the accumulated depreciation to be as high as possible. Then that would suggest that most of these assets have already been expensed out to P&L and only very few assets or few value of the asset is left over for depreciation. Balaji Amines had seen 36% of its gross block already being depreciated. Now it has only 182 crore of assets still to be depreciated, or 182 has been depreciated till now, so 36, that is 36%, and the balance of the 502 minus 182 is left to be depreciated. Philips Carbon's depreciation or accumulated depreciation is just 14%. So out of the 1746 crore of assets it still has on its balance sheet, only 246 is depreciated and balance still needs to be expensed out in the P&L account over the future years. So Philips Carbon has a lot of assets still to be transferred to the P&L account. Nocil's accumulated depreciation is 23% and Thirumalai's is 18%, again a low figure. So only Balaji and Pidilite's accumulated depreciations are high. Next, let us look at the net block and what is the depreciation charged on it. This is the net assets of the company which is shown in the balance sheet, and this is the assets the company now has after removing out all the accumulated depreciation from the gross block. And then we are trying to understand how fast it is clearing of that assets through depreciation. So the higher the rate, the less will be the profit, because if the company is transferring a very high percentage of depreciation to the P&L account, the profit will go down. Thirumalai Chemicals net assets were 383 CR, on which in the current year of 2019 only 36 CR is depreciated. That is, this is the value it has shown in the balance sheet. So that is a 10% depreciation rate. Here we want it to be as high as possible, just like in accumulated depreciation. So if the company is depreciating at a very low rate, then that will inflate the profit. And if it's depreciating at a very high rate, then that will basically decrease the profit that the company shows in its P&L account. So we want a balance of the two. Neither the company has to show a very high depreciation rate nor a very low depreciation rate. In this case, both Nocil and Phillips Carbon are depreciating their assets at a very, very low rate of 4%. These values are sourced from screener.in. So there may be some kind of error. If it is, I'm not sure. As far as I have rechecked these numbers and they seem to be all right, but there could be some omission or commission of values here, so that needs to be taken into consideration. Phillips Carbon is depreciating at a very low rate of 4%. That is, out of this 1500 CR of net assets, the company has depreciated only 66 CR this year. So it is depreciating these assets at a very low rate. Therefore, its profit will be high. Only when it starts increasing this depreciation rate charged on the net assets or net block, then the profit will start dropping or decreasing. Pidilite's depreciation rate is 9%, so this is also okay. So Thirumalai Chemical and Pidilite are depreciating at around 10% or so, and the other three companies are depreciating at around 6% and less than that. So this concludes the analysis in the graph sheet. I'll move on to the normal analysis that I do by using values, and we will give it a score, rank it, mark the ratios which are good and give them a score, and then come back and understand how these companies are stacking up against each other. I have given scores to all of these companies. Each ratio has been scored according to the value it represents. The ratio which has the best value will be given the highest score, and the ratio which has the lowest score or lowest ratio will be getting the lowest score. And if certain ratios are not fitting into my benchmark, then I have given them negative scoring. So after giving all the scores and color coding them, Thirumalai Chemicals has got the highest points in all the ratios. So this is the best company to invest in, followed by Pidilite at 147. Balaji Amines has got 129 points and Nocil has got 122. The lowest score was by Phillips Carbon at 101 points. Now I'll quickly go through each ratio and see which companies have scored the best in that ratio. Starting with face value, Nocil's face value, there was no split, so its face value is 10, so it's got the highest score. And all companies have seen splits in their shares. Thirumalai's face value is 1, even Pidilite's face value is 1, and the other two companies, Balaji and Philips, is face value is 2. Next is down from 52 weeks high. Nocil has fallen along with Pidilite. In fact, Pidilite has fallen the least from where it was 52 weeks back or 1 year back. So it has fallen just 3%. So it has got the highest score. Nocil has fallen 54%. So it has got the second highest. Although in terms of comparison with other companies, it has fallen as much as the other companies. Thirumalai has fallen the most at 64% from where it was 52 weeks back. Even Balaji Amines has fallen by 62% from its 1 year back price. In terms of earnings yield, that is what is the profit these companies are earning on per share basis, Philips Carbon and Balaji have both given high earnings yield of 18.4 and 16% each. That is, on a price of 121 for Philips Carbon, it has earned 22 rupees. That translates to a yield of 18.4%, and similar is the case for Balaji. Pidilite's price was very high and the earnings per share was just 18 rupees. That is an earnings yield of just 1.4%. So it has got the lowest score along with Thirumalai at 11%. In terms of price to earnings data of the latest 12 months, Philips Carbon and Balaji both are available at the lowest multiples. Pidilite is the most expensive in terms of earnings. Against the earnings, we are paying 68 times more to buy the shares. Nocil is the second most expensive at 7.7 times its earnings. In terms of historical 5 years price earning and historical 3 years price earning data, historically Pidilite has always been expensive, trading at 50 times over a period of 5 years and 49 times over a period of last 3 years. So Pidilite has always been trading at a high price earning multiple. Philips Carbon's 5 years and 3 years price earning multiples were high at 20 and 14 times, and in the recent 12 months it is just 5.5 times. So it has fallen quite a bit from its historical price earning. Thirumalai's recent price earning and the 5 years average and last 3 years price earning multiple were quite reasonable at 8.8 times and 9 times, the lowest in the group. So Thirumalai historically has been available at a very low valuation or multiple, and in the recent 12 months it has fallen further from its averages. So this creates a buying opportunity basically if all other ratios are intact. Balaji Amines historically has been available at 10 and 12 times. So it has got the second highest score. It is available at a very low multiple. In the recent 12 months the multiple has fallen to 6.4 times. So that is good. Next, we will look at the price to OCF. Thirumalai's price was quoting at just 2.8 times more than its cash earnings, along with Philips Carbon, where the price was quoting at 7.2 times its cash earnings or cash flow from operations. The most expensive in terms of cash flow was Pidilite, whose price was 76 times more than what it generated through cash from operations. Even Nocil was at a decent price to OCF, although compared with peer group companies, it was the second most expensive. In terms of price to free cash flow, Thirumalai and Philips Carbon both were available at a price to free cash flow which was the lowest in the peer group. Although Philips Carbon's ratio is high because my criteria is 25 times free cash flow, not more than 25 times. So here it has exceeded. In fact, Pidilite has also exceeded by its price is quoting at 109 times its free cash flow. So all of these companies except Thirumalai has a negative free cash flow for Nocil, for Balaji, and a high free cash flow against the price for Philips and Pidilite. So here, as I mentioned when we were analyzing through graphs, I had mentioned that we would want the free cash flow to price to be not more than 25 times, just like price to OCF and price to earnings. In terms of price to book value, Thirumalai and Nocil were available at the lowest multiple to its book value. Pidilite was trading at a very high book value multiple of 15.6 times, and Balaji was the second most expensive along with Philips Carbon at 1.3. Although these ratios are still good because my criteria is that the price to book value should not be more than 2.5 times. In terms of price to sales ratio, Thirumalai and Philips have done well. That is, its market cap is below the sales that it did in 2019. So we are getting the shares of Thirumalai and Philips at a discount to its sales. Nocil and Pidilite price were trading at 1.4 times its sales and 9.1 times its sales for Pidilite. So these were expensive. In terms of growth in profit over the period of 5 years and period of 3 years, highest growth in profit was seen for Thirumalai Chemicals at 54% over a period of 5 years and 52% over a period of 3 years. Nocil also saw a high growth rate in its profit of 49 and 32%. Philips Carbon, I have given 1 point only, although it has the highest growth rate over a period of 3 years. That is because anytime we see such a high growth rate in either in profits or sales, we have to take into consideration that the base year or the year from where we are calculating the growth, if that is low against the current year's profit, then we'll see an inflated value like this. So we have to account for that, and I am not giving it the highest score because anytime I see such kind of values, I look at the base price and see if that is a genuine growth rate or is it because the base year's value was low. And over the period of 5 years, Philips Carbon has no value because 5 years back the company had made a loss, and from the loss we cannot calculate the growth rate. The lowest growth rate was seen for both Pidilite, and in fact Balaji has also got a good growth rate of 27 and 25% each. But the lowest growth rate was for Pidilite at 16.1% over the period of 5 years and 5.3% over a period of last 3 years. In terms of price earnings to profit growth rate of the last 5 years, we see the best ratios were for Thirumalai for both 5 and 3 years PEG, and even Balaji was at a decent same 0.2 times PEG, although I've given it 5 number because its overall values from the beginning was high, so I have given it a higher priority than Balaji. Pidilite's PEG ratios are very high, so it has got the least score. In terms of sales growth over both the 5 and 3 years, the highest growth rate over the period of 5 years was for Nocil at 11.8%. Even Pidilite had a high sales growth rate of 10.6%, which is my criteria also. Thirumalai saw a fall or a degrowth in its profit over a period of 5 years. That is, wherever the sales was 5 years back, from there till date it has been dropping. The sales have been falling at the rate of 0.2% compounded over a period of 5 years. In the recent 3 years, the highest sales growth was seen for Philips Carbon and Balaji, and the lowest sales growth was for Pidilite and Thirumalai. In terms of return on equity over the period of 5 years on average, the highest return on equity was given by Balaji at 23% and Pidilite at 27%. The lowest RoE was seen for Philips Carbon and Nocil. In terms of recent RoE of 2019, the lowest return on equity was given by Nocil and Thirumalai, both at 16% and 18%. Although these values are above my benchmark, compared with the peer group companies, they have scored low. Philips Carbon has given the highest return on equity, along with Pidilite at 24% on shareholders' money. In terms of growth in RoE from where it was 5 years back, the highest growth rate in return on equity was seen for Thirumalai and Nocil, and the lowest growth rate was for Pidilite. That is, the RoE from where it was 5 years back has fallen at the rate of 0.3%. Next, let us look at return on capital employed 5 years on average. Pidilite has given the highest returns or profits are generated on the capital employed by Pidilite and Thirumalai, and the lowest profits or EBIT was generated by Nocil and Philips Carbon. In terms of recent of 2019 return on capital employed, again Thirumalai and Pidilite have given the highest return on capital employed, and same Nocil and Philips Carbon have given the lowest profits on the total capital employed. I've already explained all of these ratios in the graph analysis. In terms of return on assets, the highest return again was generated by Thirumalai and Pidilite, and again Nocil and Philips Carbon have scored the lowest percentage growth rate in assets. Again, asset turnover was seen highest for Thirumalai and Pidilite, and Nocil's assets were turned over the least along with Balaji Amines. In terms of return on invested capital or core return from business, Thirumalai and Pidilite as usual has scored the highest points. In terms of conversion of profit of the last 5 years into cash, the maximum conversion was seen by Thirumalai and Philips Carbon. They've received the highest cash against the profits of the last 5 years, whereas Pidilite saw a shortfall in its cash coming in from operations by 4.2%, and Nocil saw a low growth or a increase in cash but at the lowest level at 3.4%. In terms of free cash flow, Philips Carbon has the maximum free cash flow from the cash it earned through operations, along with Pidilite. Both Pidilite and Philips Carbon have utilized the least amount in investing in fixed assets from the cash earned through operations, whereas the maximum utilization of cash into buying of assets was by Balaji Amines at 76%. Nocil utilized 48%, although this value is good because my maximum limit is 50%. That is, I don't want the companies to use up cash earned through operations into buying of fixed assets of more than 50%. Next, we'll compare how the current year's profit has scored against its 5 years average. The maximum profit gain over its 5 years average was for Thirumalai and Pidilites. Both the profits for both these companies have grown at 26% above its 5 years average and 15% above its 5 years average. Balaji also managed to grow its profits at 43% above its 5 years average. The reason why I have not given Philips Carbon and Nocil the highest score, although their profits are the highest against their 5 years average, this is because whenever I see a very high value against the averages, I give them the lowest score, so that what I'm doing is I'm looking at the 5 years average, and generally we don't see these kind of inflated values in normal companies. So whenever I see this kind of scores, I normalize them to the lowest level. So that is why they've got 1 and 2 points, whereas Thirumalai has got 5 points for a score of 26%, and Pidilite has got 4 points for a score of 15%, whereas Balaji Amines has got higher percentage gain but a low score. This is just a scoring method. Next, we'll look at how the profits have grown year on year. Thirumalai has seen a fall in its profit from 2018. Even Pidilite saw a fall of 2%, so both have got a negative scoring. Nocil saw a growth of 6.6%, highest in the group. Philips Carbon also saw a growth of 67% from where it was a previous year. In terms of quarterly sales growth and quarterly profit growth rates, all these companies have performed very poorly. So most of these companies have got a negative scoring. In terms of cash flow from operations in the annual comparison against the profit, Thirumalai's cash has come in at the highest, above its profit after tax, and most of the other all four companies have had a shortfall in their cash against the profit in the recent year. Most of these companies have not managed to gain more cash than the profit that was shown in the P&L account. In terms of net worth, the highest net worth was for Pidilite at 4000 CR and Philips Carbon at 1650 CR. Balaji Amines is a small cap company along with Thirumalai at around 574 CR and 668 CR. In terms of contingent liability, the highest contingent liability was seen for Pidilite at 7.5%, although this is still within my benchmark of 20%, less than 20%. So all these companies have managed to keep their contingent liability within a reasonable range of the net worth. In terms of debt to equity ratio, the highest debt to equity ratio was seen for Philips Carbon and Balaji. Again, these are low compared to my benchmark. My value is 1 times, that is 1. Interest coverage is good for all companies, but the highest coverage was seen for Nocil because it's a debt-free company. It doesn't have any debt. Even Pidilite's debt is 0 and its coverage is 53. That is, its EBIT or earnings before interest and tax is 53 times higher than what it paid as interest cost. In terms of borrowings to profit ratio, that is what was the multiple of the borrowings against the profit, or how far away the borrowing is compared to the profit. Or we can also look at it in this way: how many years would it take using the current year's profit to pay off the total debt the company has. In this case, most of these companies have a very low debt. The highest debt to profit was for Philips Carbon. It will require 2 years of profits to pay off its debt. This is also low. We don't want a very high value here. In terms of promoter holding, the highest promoter holding was seen for Pidilite at 69% and Philips Carbon at 53.6%. Nocil's promoters holding is low at 33%, although all of these companies are above my benchmark of 30%. None of these companies have a high pledge against their promoters' shareholding except Nocil, whose pledge percentage was 25% and it is above my benchmark of 20%. So I've given it a negative score. And the promoter holding is also low at 33%. And none of the other companies have pledged any of their shares, so that's a very good point. In terms of debtors to sales, that is how much was still to be collected from customers against this year's sales. The highest debtors to be collected was by Nocil at 22% of its sales. Philips Carbon's debtors collection were 18% of its sales, the highest. And the lowest collection was for both Thirumalai and Pidilite. So they have done well of collecting most of the payment from the customers at a quick pace. Next, let us look at how the company has been collecting, in how many days is it collecting payment from the customers. The fastest collection was seen by Thirumalai and Pidilite, and Nocil was taking a lot number of days compared to the peer group companies. Philips Carbon is taking 67 days to collect payment from the customers, although all of these companies are below my benchmark of 90 days. 3 years back, Nocil was still taking 77 days and Philips Carbon was taking 84 days. So they have improved from 84 to 67 days. They are collecting it in much faster number of days. But for Nocil, it has in fact worsened. They're taking more number of days from where it was 3 years back. Next, let us compare the inventory turnover and inventory turnover 3 years back. The highest inventory turnover was seen for Philips Carbon at 9.2 times into sales, and Pidilite's inventory were converted 8.1 times into sales. The lowest inventory turnover was seen for Nocil and Balaji Amines. 3 years back, the highest turnover was for Thirumalai and Pidilite, and the lowest turnover was seen for Nocil and Balaji Amines. In terms of 5 years operating profit margin, Thirumalai has fallen short of my benchmark of 15%. Even Philips Carbon has fallen short of 15%. And the other three companies, Nocil, Balaji and Pidilite, have all managed a 20% operating profit margin over the period of last 5 years. In terms of net profit margin of the latest year, again Thirumalai has fallen short of the benchmark. Philips Carbon is very near to the benchmark of 10% in NPM. Nocil has seen the highest OPM and highest net profit margin for 2019 as well as 2018. Even Pidilite has seen the highest OPM as well as net profit margins. Philips Carbon's operating profit margin is 12%, which is way below my benchmark of 15%. And in 2018, its net profit margin was also below 10%. In terms of current ratio, the highest liquidity position was there for Balaji. Its assets were 2 times more than its current liabilities. And the lowest ratio, current ratio, was for Thirumalai and Philips. In terms of quick ratio also, Thirumalai's assets or quick assets were not enough to cover the current liabilities, and Philips Carbon's current assets were, quick assets were not there to pay off the current liabilities. And Nocil, Balaji and Pidilite were all in a comfortable position to quickly pay off its current liabilities. In terms of accumulated depreciation, the highest accumulated depreciation was seen for Pidilite and Balaji. Almost 42% of the gross block was already depreciated for Pidilite, and Balaji's gross block was depreciated by 36%. The lowest accumulated depreciation was for Philips Carbon and Thirumalai, which means these assets still needs to be depreciated over the future years. In terms of depreciation rate charged, the highest depreciation rate charged was by Pidilite and Thirumalai at around 9%, and the lowest depreciation was for Nocil and Philips Carbon. I've given them the lowest score because when the companies charge a very low depreciation rate, it basically inflates the profit. So in this case, even though Thirumalai depreciation rate is at 9.5%, its profits are still intact. In terms of dividend yield, the highest dividend yield was given on the current price, calculated on the current price, was by Thirumalai and Nocil, and Pidilite and Balaji Amines' dividend yield were the lowest. Now I have grouped all of these 64 ratios into 6 metrics. I have efficiency metric, which I have given a weightage of 6 points, and cash flow metric at 5 points, That is, for me, which matrix is of more importance, I've given it more weightage. In the efficiency metric, we have asset turnover, contingent liability to net worth, and so on. All of these ratios are clubbed together under efficiency metric. I'm trying to understand here how efficiently the company is turning over its assets into sales, how well it has managed its contingent liability against its net worth, where is its debt against the equity, is its EBIT enough to pay off its interest cost or finance cost, how well is its debt against the profits, is it earning good profits to pay off those debts, and so on. In cash flow, I'm looking at how the profit has got converted into cash and how much of the cash has been utilized in buying of assets. That is what how much free cash flow is still left out with the company. In the growth metric, I'm looking at how the company is growing its sales and its profits over a period of 5 and 3 years, and even quarter on quarter or year on year analysis. In terms of solvency metric, I'm looking at promoter shareholding, if the promoters have done any pledge, the current ratio and the quick ratio. In the return metrics, I'm looking at the return on equity, how much profit it has generated on the shareholders' money, on the capital employed, on the assets, on the invested capital. What is the profit margin it has, and what dividend yield it is paying. And finally, the lowest metric for me is the valuation. Only when all of these above metrics are in order, then we can look at the valuation metric and try to understand where the price is compared to different variables like operating cash flow, free cash flow, book value, sales, PEG, price to earnings, and so on. And I have given them the score in based on the weightages. That is, if it has got 41 points for efficiency, I have multiplied by 41 by 6, so 246, and so on for all of them. So after giving the scores for all of these companies, in terms of efficiency, the highest efficiency was seen for Thirumalai and Pidilite. Both of these companies have a very efficient model of working. They have managed their different variables in the best manner. Pidilite's efficiency is the best at 44 points. Philips Carbon's efficiency is the lowest, receiving only 25 points, and Nocil at 26 points. In terms of cash flow, the highest or the best cash flows for these companies was seen for Thirumalai at 12 points and Philips Carbon at 6 points. Balaji Amines' cash flow was not very good, and in fact it has received a negative scoring. In terms of growth metrics, that is the sales and profit growth rates, highest growth rates were seen for Pidilite at 24 points and Nocil at 22 points. The lowest growth rate in profit and sales was seen for Thirumalai at 13 points and Balaji Amines at 14 points. In terms of solvency metric, the best available scores for solvency was for Balaji and Pidilite. Philips Carbon has scored the lowest in terms of solvency at 17 points. In terms of return metrics, that is how well it has earned on different variables, Thirumalai's score has come the least at 6 points, followed by both Nocil and Philips Carbon. So their profitability ratios are not good. The highest profitability ratio was seen for both Balaji and Pidilite. In terms of valuation metric, which company is the most economically priced? Balaji and Thirumalai. In fact, Thirumalai has got the highest points of 44, so it's the cheapest one available in terms of valuation. And Philips Carbon also, in fact, Balaji Amines has scored the second highest. So these two companies are available at a very good valuation, but other ratios has to be looked into. In that case, Balaji's cash flows are not good. So we need to take care of this. Why its cash flows or free cash flows, as we saw earlier, had been used. The entire cash from operations was utilized in assets, buying of assets. So that is why the cash flows are not good. So after giving all the scores, okay, in terms of valuation, Pidilite was very expensive and it has got the lowest score. So after concluding all these numbers, we can say that Pidilite has got the highest score. Even though it is most expensive, fundamentally it is the best company in the group at 543 points in total, and has got the first rank. Thirumalai has got 498 points. Here the growth is not there and profitability ratios are not good. Even then it has got the highest points. Nocil has got the third highest points at 391, followed by Balaji at 388, and the lowest scored company was Philips Carbon at 332 points. It has got the lowest efficiency and lowest solvency. So this concludes my analysis for these companies which are into chemical sectors. Thank you for watching this video.